Good morning class, this is your instructor. Today I'm going to be talking about the last week's lecture, which was pertaining to a worksheet after we did the direct and indirect methods in the cash flow statement. And now if you just look at this question, which is about, this is just one of the examples, this is about the formation of the worksheet, where we have the previous year and the current year, and you can just actually determine the changes which are actually taking place in this whole scenario, where we have cash as 50,000 and then we have reduction in cash. As you can see here, that there's a reduction in cash till 45,000. So I can just simply say that over the process of the whole financial series of financial operations, you can say this, whatever it took to finish the operating cycle, investing in all the activities that are part and parcel of the business cycle, it resulted in the net decrease in cash. So market securities have also, if you can see, that they have decreased to 15,000, decreased by 15,000, which means that these securities were disposed of. Now, accounts receivable. So first of all, you have to do the analysis of the balance sheet, right? Which would mean that you have to see the direction in which the receivables and the payables are also going. And this is an increase in the accounts receivable. So what impact this would have on the balance sheet? It's going to reduce the balance sheet. Now, what impact can it have on the cash flow statement? It would be at the end of the cash flow statement that we would be able to reconcile this amount as a net increase or decrease in cash, which we have to reconcile with the cash flow statement of 5,000. Then we have accounts receivable by 10,000. I've already explained to you that when an accounts receivable is increased, the cash flow statement would be registering sort of like a cash outflow. It would be synonymous to a cash outflow because the receivable is akin to the debtors, right? The trade debtors, if increasing, would mean that they're not going to be paying you any cash. So for this reason, this increase in receivables would reduce the cash flow statement in the operating activities side. Then we have a reduction in inventories. So this is going to be reducing the balance sheet naturally, but any kind of receivable in the short run would be registering. Now, since as you can see, this asset has reduced, could be increasing our cash flow statement, because now since this is not as per the accrual system of accounting, it's going to be cash based. In the previous lecture, if you just go back to that, refer to it, we have already assumed that we're not going to be taking the accrual system of accounting, we're going to be going by the cash basis. So it is assumed here that if inventory is reduced, definitely you're going to be receiving money for that. So now you have the plant and equipment. So the net of accumulated depreciation would mean that, now this is not just the only thing, I would just go towards the adjusting entries for that. And it's very important for you to look at what is being asked before you read the entire question. So now you see, okay, this is very important for you to know that net income is $250,000 and dividends were $140,000. They are going to reduce the retained earnings, and the net income is going to be increasing it. Similarly, we have the non-cash expense of depreciation, 60,000. Okay, what else do we need to know? So if you see that, okay, so now, I don't know if you can really see, this is, the font is very small, but this would be 600,000 beginning balance. And anything which is purchased, now what is purchased? Plant asset, okay. So it's going to be 600,000, something like that, so it's 600,000, which is the beginning balance of plant and assets. 100,000 was actually added in that, and 40,000 of depreciation was subtracted, and the net result is actually 640,000, because, oh no, sorry, this is, depreciation is not 40, it's 60,000, I think, yes, sorry. This has to be 60,000. Yes, this depreciation is actually 60,000, okay? So this is 640,000. as highlighted in the and part of the year, which is actually the beginning of the new year. And in this case, it's 640,000. Now you can look at the liabilities after you have started or inspected this asset side. Now let's look at what we are supposed to include in the cash flow statement for the liabilities part. Accounts payable naturally will be part of cash flows because this is a current item. This largely implies that we have the payable by the suppliers. So we are considering that we are a manufacturing concern. Even if you weren't a manufacturing concern, we would be, let's say, a services sector or merchandising sector. All of the focus is on inventories would mean that this is a manufacturing concern or a retail business, but whatever it is, it nevertheless it's not service sector. So had it been a service sector like Bettner University or any other university for this matter, I won't want to compare myself to an inventory. However, since the university has employed its staff to demonstrate or deliver lectures, so that would mean that they have to pay us something, and that would be something similar to selling your inventory. So it's accounts payable in that case. Now this is increasing. Okay, so now when payable is increasing, it would have a positive effect on the cash flow. So it's going to be having a positive effect on cash flow. Although it's bad for the balance sheet, but this is a very shrewd way by which we can determine whether the company is doing well, because just looking at the balance sheet is not enough. So now you would actually know why it's important to actually look at the cash flow statement, because this is going to be part of the operating activity, although this is something that we have to pay back. So this does not look very well or bode very well for the future of the business if they are not giving back this. They are not paying back or they are adjusting their dues. So what we need to do is to look at individual items in the cash flow statement. And then we have accrued expense payable. Obviously, it's a short-term item within the year, so payable within the year. So that is, in this case, it's reducing to 45,000. So since we are going to be making payments, it's going to have a negative effect or impact on the cash flow statement in this case. Then we have a mortgage note payable. So in this case, this is, as you can see, it's a long-term item. We are going to be excluding it from the cash flow statement. We have bonds payable due in 2023. So we are not going to be including that, although it has increased. You can just see that it has registered an increase for the balance. This has reduced. Payable has reduced. So, but if it is due in 2023, so we are going to be including the entire amount. But if in the current year, now if you see that although it's a long-term investment, but the current year has registered, 150,000, some kind of, payment in the current year. So this could be included in the cash flow statement. And capital stock, if increasing, but in this case it stays the same, so we're not going to be, I think, doing much about it in the cash flow. And retained earnings, now capital stock remaining constant also implies that they have not issued any fresh stocks. And retained earnings would mean that either the net income has increased or that they have, not paid any dividend. And since this is, we have, I think, paid dividends in this case, or you can simply see that from the adjusting entries, there were 140,000 dividends, and you can just see from the working here. I have to enlarge this now. Okay, so this is, I hope you can just, close in on this. So you can just see the retained earnings, and you have a positive increase with the net income, but you have a negative. So this is a credit, its nature is credit, okay? So that's why any debiting this would reduce the retained earnings. So it's basically the ability of the business to reinject funds into the business, back again in the business. Now, this is largely what I have explained to you. This is net income. We would add back depreciation because it's a non-cash item. And then we have accounts receivable increase, so we are going to be reducing the cash flow statement with that. And there's a decrease in inventory, like I told you, that any decrease would mean that we have received some cash in lieu of that. And then we have decrease in accounts payable. So we have received some cash or whatever maybe some kind of an inventory, but it's an accounts payable, so we have payback, or whatever that it is assumed that it's going to be in cash form, otherwise we won't be including it in the cash flow statement. And then we have decrease in payable would mean that we have paid off something, so it's a cash outflow. Okay, now the tricky part here is the 20,000, which is gains on sales. So I'm going to be making an entry for you to understand that proceeds, investing activities are basically about the investment in other companies' securities or other companies' bonds, or you're going to be disposing of your assets, like or you're going to be acquiring them. This way, you can account for the cash outflow and inflow from investing activities. So when you acquired the plant assets, 70,000 was, I guess, some note payable, and this 30,000 was the cash that was outflow. But the proceeds were 35,000. So the entry that you would make is basically cash to marketable securities, whatever the. Now this is 35,000. Proceeds would mean that you have received cash for that, and then you had gains. So that was 20,000. So now naturally you can determine that this is cost, and I can also read up the adjusting entry, so you can just know what was the statement in this. See, they say that marketable securities costing 15,000 was sold for 35,000 cash, resulting in a 20,000 non-operating gain. Now the question naturally arises, if it's a non-operating gain, then why is it included in the operating activities? The reason is because, see, when we were calculating the net income, this included the gain, okay? So the net income has the gain included in it, so we have to naturally subtract this gain back from it, because we have already recorded the proceeds as 35,000. This 35,000 is already recorded here. Now we don't want to record twice. We can't have 20,000 and then 35,000 and then we'll be actually recording 55,000, so it's going to be sort of like a double entry, an overstatement of the cash inflow. So we are going to be having the proceeds here, but we are going to be deducting it at the same time from the net income, because that was already added back, just like in depreciation expense that was already netted off, and so we have to add that back, and this way this has to be subtracted. Okay, you can see that dividends paid is now, this is a financing activity, unlike dividends received, because dividends received are either part of operating activities or the investing activities, and now this the discrepancy between the IFRS or the GAAP. So we are following the IFRS, therefore we can either place them, it gives us the flexibility to place them in the operating and investing activities, but the financing activities would have the dividends paid actually and not dividends received, because you receive something arising out of the activities like selling of the securities. So similarly we have payment of bonds payable. Like I said, this was short-term payment. Although this is a tricky part because you have okay, let me just go back to this. Okay, maybe this font is too large now. So I can just simply tell you that, where is it? Oh yes. Okay, so now this was due, I think maybe for 2023, but you paid this portion, this one, in the current year. So you have to be really vigilant in order to know which is the current outflow. I have to do a question now. Let's just move quickly to the question. Okay, now one more important thing before I conclude this example is that if you see that we have a net decrease in cash. So this net decrease in cash is actually reflected in the balance sheets ending. It would affect the ending part here when we reduce this cash, okay? And this has to coincide with the net increase or decrease. So in the exam, your question would be correct if you match both the values. Okay, let's just move on to the question now, which is, I guess, problem. Okay, we go to problem. So we have to trace those problems which are demanding from us the worksheet. Okay, so this is okay, just always read the instructions and whatever they are This is the instruction, so you have to see what they're asking you to do. The requirement is important before you actually start reading out the question. Okay, it does not ask us to make a worksheet. So we are going to be, skipping through the questions. Let's just move on to okay, now, yeah, this is asking us to prepare a worksheet, and this worksheet would actually comprise of all the processes which are involved in, making up the balance sheet, studying the balance sheet basically, and then you can also take the effects in the cash flow statement. Now, I've reduced the font. Yeah, I again, okay, this is, hope you can just see this. Yeah, I think it's clear to you now. Okay, so there's paucity of space, so I'm going to be, rubbing this off and making, at the same time, I'm going to be reflecting the changes. I'm not going to be making the columns, but I'm going to be drawing them side by side. But you're supposed to insert those columns inside or in between these 2 years. So those columns will be one of debit and the other of credit. So in this question, let's just see what they're asking us. First of all, what you're going to do is read up on the balance sheet and see what are the changes. So now cash and cash equivalents. Okay, it's not that visible, so I have to reduce the font. Yeah, okay, so now you see that this is 2017 and 2018. I'm going to be drawing a debit here and a credit. Why? Because these two have to be placed in between the 2 years. So these will be two different columns. Then you can just trace the net effects that will take place for them to lead on to this year. So we have 80,000, which is cash and cash equivalents in this case. So from 80,000 it goes to 37,000. So now that means that there's a difference between, there's a downward trend of cash, so it's a decrease by 43,000. So that means that this is a credit registered here. Okay, I'll just wait, let me just see if the recording is still on. Okay. Now accounts receivable has this is 750,000. Now you can see this is an increase, so I'm going to be debiting 750,000 here. Then we have, okay, now this is, again, I'm going to be going towards the adjusting entries because plant and equipment. Now, if you see, now net income is 440,000, depreciation is 147,000, and we have plant assets 2.2 million, out of which 1,850,000, that is the only figure we are concerned with because that will be included in the cash flow statement, and we are not going to be including 350,000, but that's a long-term note payable, so it's not being paid this year, so we're not going to be settling it this year. So let's just put it aside at the moment. Now we have, in this case, as you can see, you had the beginning balance of 600,000, then you added in it, let me just do this small work in here, 600,000, come up with 2,200,000, and subtracting the depreciation, which was 147,000. So you have to remember the figures, and the net effect would be this 2,653,000, and let me just do it for you on the calculator as well, so you can have a better. Okay, so we had 2,000, add 600,000, subtracted by 147,000 so this is 2653,000, okay? So now you can see this is 2653,000 right here. So now this is actually an increase of 2053 in a nutshell. So we are going to be debiting it, right? Then we have notes payable, which is short term, and it is increasing. So we are going to be crediting the liabilities side, which is 1,450,000. Okay. Then we have accounts payable, 33,000, again increasing, 33,000. Then this is as you can see, this is going down from 45,000 to 32,000, which is accrued expense payable, and that is going to be 13,000. So now I'm going to be debiting this by 13,000 because this is reducing the liability, and it's a cash outflow as well because you're paying out something to adjust your liability. Notes payable is long term, and it's 350,000. We're not going to be including that, although the difference I can just simply state here, which is 350,000. We just simply add that up, and then we have 500,000 as capital stock. Again, we are going to be adding that in the cash flow statement because the new stocks have been issued, and the entry that you make is cash to capital stock by 500,000. All we're supposed to have a par value and a paid-in cap, but let's just, for discussion's sake, just say this is the entire value that we take. And we have retained earnings. Now, as you can see, okay, what is the retained earnings statement? We have the opening retained earnings as 115,000. And we have net income, but we don't have, I guess, any dividends in this case, like I wrote it up. And this is, what was the value? Okay. Yeah, it's 440,000, no dividend, right? So we have net income of 440,000, and the dividend is 0. So what we have is 555,000. Okay. Now this is, reflecting here. Let me just adjust this again for you to see. Now this is let me just
ये मैंने कहते हैं अपने रिकॉर्डिंग की दूसरी फिल्म चलाने में वाशरूम से वजू करके आती हूँ नमाज पढ़ने में.
So this has to be shut down then. Okay, so now this is basically 115 and 555,000. So we have approximately retained earnings of 440,000, right? Now quickly we're going to be making a cash flow statement. Cash flow statement. As you can see that we first of all begin with the operating activities, and where we have net income. Net income in this case was 440,000. So there is going to be a debit, it's going to be a credit. So our net income, basically, I think you can just state it like this, or you can just simply have this as whatever is going to be added in this final figure of if something is reduced, you can just simply put a bracket inside. So now net income, you just add depreciation. Now this is how much was that? 147,000. Sorry, this is added back. Then what else do we now need to include? Is accounts receivable. accounts receivable increasing by 750,000. So now we are going to be reducing that. So 750,000, you can just simply reduce it like that, or you can just maybe put it right here towards this column. Then you have accounts payable, or you can just maybe for ease sake just put it here so that you know it's whatever is outflow, whatever is inflow you can just simply debit, and whatever is outflow is just simply you can credit out. And then this is 70,000. Then we have accounts. Okay, now we also have notes payable, but we are first doing the operating activities, so we are going to be doing the accounts payable, which is 13,000. Accounts receivable is done, accounts payable of 13,000. Since this is going to be also our outflow because we reduce the liability, and we have accrued expense payable. Accrued expense payable, which was this was oh sorry, I think this was 33,000. No, 13. This is accounts payable. This is sorry, it's increasing. So this is going to be added up. Yes, this is increasing. It's going to be added up. I misread that. Yeah, it's going to be added. And the next is actually reducing, so we are going to be subtracting that. So this is 13,000 is our outflow. Okay. Then this would I think be the conclusion of the operating activity. Then comes the financing activity. The financing activity would actually have, you can just sum them up individually. The financing activity would actually have the but before that we also have an investing activity. Okay, one investing activity was the disposal of plant asset. Oh yes, 1,850,000 in cash. Okay, yeah. So we have outflow of 1,850,000 in cash and 0 here. So now we have financing activity where we have short-term notes payable because that's a borrowed thing, and we are going to be having the amount as an inflow because 1,450,000, because that is what actually increased. Then we also have Asif memory see कितने मिनट रह गए?
बस last minute है.
Then we also have the okay, now we are going to be having the capital stock, not taking the retained earnings at the moment. The capital stock would be 500,000. That would be increase, and you can just simply sum them up and reduce, and let's just observe what is the net change in this. And now you can just simply take the calculator and just see the values that are in this. So we have 440,000 plus 147,000 plus 33,000 plus 1,450,000 plus 500,000 and subtracted by all the remaining values to get you a net cash outflow. Okay, so 750,000, our target is what was given to us in the beginning on the balance sheet, because we all could already see that there was a reduction of 43,000. 13,000 subtracted by 1,850,000, and you get about 43,000. That is the nutshell, and here this is the target that we wanted, and as you can see that this is the net increase. So it's basically opening cash, and we have closing cash here. Net decrease of 43,000, then opening cash was 80,000.
Ma'am, close.
मेमोरी नहीं होगी इसके अंदर.
जी start करें. है आधा घंटा और मैंने कहा ना हाफ ऑफ आवर की आधा घंटे की बनाएगा
अच्छा
अब कंटिन्यू रखें आधा घंटा और
नहीं it's just 1 minute no conclusion
आप करें आप कंप्लीट करें बहुत है
okay class so now
आप
I'm
आधा
just
घंटा लगाएंगे
okay class so I'm sorry there's a limitation on the amount of time that I can give to a video so I have to begin again with this so this is like I said that we calculated from the calculator so now it's opening cash